Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CATALYST Pharmaceuticals Inc. quarterly report. CATALYST Pharmaceuticals Inc. offers a range of medicines for patients living with rare diseases in the United States. The company's primary focus is on developing and commercializing treatments for specific conditions. One of its key products is Firdapse, which is used to treat Lambertian myasthenic syndrome, LEMS. Additionally, CATALYST Pharmaceuticals provides Fycompa, a medication that helps manage focal onset seizures and tonic-clonic seizures. The company's portfolio also includes AGAMRE, a corticosteroid for the treatment of Duchenne muscular dystrophy. Furthermore, CATALYST Pharmaceuticals has partnered with other companies to expand its offerings. For instance, it has a license agreement with BioMarin Pharmaceutical Inc. and a collaboration and license agreement with Endo Ventures Limited for the development and commercialization of generic Sabril tablets. In summary, CATALYST Pharmaceuticals Inc. provides treatments for rare diseases through its products Firdapse, Fycompa, AGAMRE, as well as generic Sabril tablets in partnership with other companies. CATALYST Pharmaceuticals Inc. maintains a market capitalization of $4 billion, broadly in line with the industry peer group. CATALYST Pharmaceuticals Inc. trades at a higher price-to-earnings ratio of 18 times and a higher price-to-book ratio of 3.76 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The balance sheet appears very conservative, with liabilities representing only 14% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth and decline are multifaceted and influenced by various factors. On the growth side, product revenue has increased by 5.6% due to FDA approvals, sales from collaborative arrangements, and government-mandated rebates. Additionally, license and other revenue have seen a significant surge of 123.8%. The increase in sales volumes for Firdapse and AGAMRE, as well as milestone payments and royalty payments, have also contributed to the growth. On the decline side, several factors are at play. Reductions in trade discounts, prompt payment discounts, copay assistance programs, product returns, and provider chargebacks have all led to a decrease in revenue. Government rebates, payer rebates, and bridge and patient assistance programs have also resulted in reduced revenue. Furthermore, the expiration of patents for AGAMRE and Fycompa has led to generic competition, causing a significant decline in net product revenue for Fycompa. Net income and profit margins. A shift in favor of growth, the financial performance of a company has undergone significant changes between 2025 and 2026. Notably, net income has increased from $56,737 to $63,734, marking a substantial rise of $7,007,000 or 12.4%. This upward trend is also reflected in the profit margins, with operating profit margin increasing from 44.8% to 49.1%, and net profit margin rising from 40.2% to 42.4%. The reasons behind this shift are multifaceted and not explicitly stated. However, it can be inferred that various factors have contributed to these changes. The commercialization expenses for certain products may have played a role, as the information on page 45 suggests an increase in such expenses for FIRDAPSE and AGAMRE. On the other hand, FYCOMPA's expenses declined due to generic competition. Additionally, cost of sales, royalties, and repurchases of common stock might also be contributing factors. The overall impact of these changes is a significant improvement in net income and profit margins. This trend indicates that the company has successfully navigated various challenges and is poised for continued growth. The company is indeed generating positive operating cash flow. This can be seen in the financial data for both 2025 and 2026, where the net cash provided by operating activities is consistently high. In 2026, the company reported an operating cash flow of $59,587,000, while in 2025 it was slightly higher at $60,043,000. These figures indicate a strong ability to generate cash from its core operations, which is a positive sign for the company's financial health and stability. The company's debt level has remained relatively stable over the past year, showing no significant changes. However, its interest expenses have seen a notable increase. Specifically, there was a 36% jump from $103 in 2025 to $140 in 2026, and a 17.9% rise from $5.3 million to $6.2 million over the same period. These increases indicate that the company is paying more for its debt obligations, which could have implications for its financial health and bottom line. The company's management is optimistic about its future outlook, expecting continued growth in product revenue primarily from U.S. customers. The sales of FIRDAPSE, AGAMRE, and FYCOMPA are expected to constitute virtually all of its product revenue for the foreseeable future. To achieve this growth, the company plans to acquire assets that will drive growth and revenue, with a significant contributor being the acquisition of FYCOMPA's U.S. rights. Management is also focused on increasing awareness among healthcare providers about the benefits of FIRDAPSE in treating LEMS, as well as exploring additional indications beyond DMD through life cycle management. However, they anticipate paying significant portions of study or trial costs upfront and expect a decline in commercialization expenses for FYCOMPA due to declining sales and generic competition. The company is also investing in its own supply chain to manufacture AGAMRE by the end of 2026, which will reduce reliance on third-party contractors. Additionally, management expects net product revenue to continue decreasing in the future due to generic competitors entering the market, but they are confident that their business expansion initiatives and product acquisitions will drive growth. Overall, management's strategy is focused on driving growth through product sales, expanding its portfolio, and increasing awareness among healthcare providers. While there are risks and uncertainties associated with this strategy, including regulatory compliance and competition from generics, management remains optimistic about the company's future outlook. Concerns about inventory buildup are warranted. The recent financial data reveals a concerning trend regarding inventory buildup. Despite the initial decrease in total inventory from $37,166,000 to $34,930,000 between March 31, 2025 and December 31, 2026, there is evidence of an increase in inventory levels throughout 2026. Specifically, the data shows that inventory increased by $2,236 in 2026. Furthermore, a comparison of the inventory levels on December 31, 2025 and March 31, 2026 reveals a slight increase from $37,166 to $34,930. These numbers suggest that there may be an accumulation of inventory, which could have implications for the company's financial health. The buildup of inventory can lead to increased storage costs, reduced cash flow, and decreased efficiency in production and distribution processes. Therefore, it is essential for the company to address this issue promptly to prevent any potential negative consequences. That concludes the financial summary for CATALYST Pharmaceuticals Inc. Feel free to comment below, and I will be happy to answer them when possible.